One of the biggest problems with active money management is that it's very expensive. And it's not just fund managers you pay. You could be paying fees and charges to all sorts of people. For example, stockbrokers, investment advisors, accountants, market makers, transfer agents, mutual fund distributors, and income tax agencies. They're rather like silent partners, not necessarily doing very much, but all happily taking a share of your investment returns. Sadly, that's how the investing industry works. You take all the risk and you provide all of the capital, but everybody wants a slice of the pie. So, how much of your returns are you losing to fees and charges? Well, based on data reviewed by IFA for the 15-year period ending December 31st, 2021, investors in taxable accounts would have kept only 65% of the growth of $10,000 of an average active equity fund compared to 95% of the growth they would have earned in an S&P 500 index fund. Active investors also pay more tax. This chart shows the tax implications of investing in the average active equity fund compared to an S&P 500 index fund for the 15-year period ending June the 30th, 2022. After tax, $10,000 invested in the active fund would have grown to $16,658. The same amount invested in the index fund would have grown to $30,450. Also bear in mind that the higher the fund's turnover, in other words, the more your fund manager trades, the more you incur in tax and other costs. Passive funds keep trading to a minimum, but many active funds have a very high turnover. Last but not least are fund management fees. This chart shows the difference in expense ratios between the average actively managed fund and a 60% stock, 40% bond index portfolio. As you can see, the active fund is more than 3 times as costly as the blend of indexes. Of course, all investing incurs costs, but by keeping those costs and those silent partners to a minimum, you can end up with significantly higher investment returns.